I have with me right now Mr. Sanjay Bahl, who's Group CFO at Raymond. Thank you very much, Mr. Bahl, for being with us here on NDTV Profit. Can you tell us about the performance in this quarter? What led to this growth?
Yes, certainly. We have seen improved performance across our key businesses. And this is testimony to the fact that our sustained investments that we've been doing in brand, in a retail network, coupled with our operational and sourcing efficiencies and initiatives, has led to the improved performance across the core textile and apparel businesses. In particular, our B2C shirting business has grown aggressively by 32% last year, driven mainly by channel expansion as well as by product portfolio expansion. The textile segment, as a result, has seen significant improvement in margins. The other benefit that we have got is the lower raw material prices as well. Coming to apparel business, this continues to grow at 15% plus, and we have seen this now pan out over the last 8 quarters. All our brands have registered double-digit growth, and this is again a testimony to the fact that our strategy on brand positioning has played out very well in the last 1 year, and our growth has exceeded the market growth rates. Our EBITDA for apparel business has also improved year on year. Coming to our garmenting business, has seen increased offtake in Q4 and improvement in our performance in garmenting. Our capacity utilizations are also now going up. We acquired a new unit last year, and that is now resulting in additional revenues as well. Lastly, coming to our engineering businesses, the focus was to restore profitability through product rationalization, cost reduction initiatives, and these are now showing early signs of improvement in performance. So overall, all these factors have contributed to improved results for the quarter and also for the year.
Right. But talking about FY16 in particular, overall, the consumer sentiment was quite subdued and you managed to end the year positively. Do you think that's sustainable in FY17 as well?
See, if you look at the overall demand situation, you are absolutely right. 15-16 was challenging in terms of subdued consumer sentiment and a difficult global economic environment, which was impacting the export-driven businesses. The domestic side also, the demand scenario was weak. The apparel business also witnessed extended end-of-season sale periods and discounting by the e-commerce players. However, having said that, our strategy to continue to invest in store renovation, new store designs, and product portfolio is giving us very positive results. We have recently launched our flagship store in Bangalore under the Raymond ready-to-wear brand, and that has exceeded all expectations from our side. It's doing exceedingly well, and going forward, we have ambitious plans for expanding Raymond ready-to-wear and also our MTM portfolios. So we have a measure of cautious optimism for next year, and we see that our double-digit growth in apparel should continue. We see a shirting business delivering volume and value growth, and the momentum should continue for next year. Our suiting business should see single-digit value growth as well. So overall, I think the sentiment, as I said, is one of cautious optimism. We are looking at a capex investment as well of around 250 crores over our new store renovations and new outlet openings. So all this should aid our revenue growth for the coming year.
Right. So 250 crores is the capex for FY17. How does it compare to FY16? How much was it there?
See, the capex of 250 crores is, when you compare it to last year, we spent 300 crores in capacity additions and renovations and expansion plans. So it's more or less in line. As far as advertising spends are concerned, our spends are around 5% of our turnover, and that is an investment that we will continue with. We will continue to invest in our brands, and that is what we believe will give us long-term improvement in our results and help us to scale up our businesses.
Right. Mr. Bahl, your margins have improved significantly. What's the outlook ahead for FY17?
See, the margin improvement has been through a mix of factors, and this is through lower raw material prices. It has been through operating efficiencies. For the next year, we believe that there should be stability in the commodity prices. We don't expect volatility for next year. Our operating efficiencies are sustainable and should continue. And we expect that the margins that we have achieved in 15-16 should continue for the next year as well.
Can you tell us what is the total revenue from exports? What's the contribution there?
Yes, last year 21% of our turnover was from exports.
Okay, and what's the outlook? Why am I asking? Because, you know, the demand scenario, the external environment looks pretty weak right now. So how are you positioning yourself? How are you planning to expand it further?
The export market is challenging because there is slowdown in our key markets. Currency devaluation has happened across the emerging economies. So that is a downside. But what we are also doing is we are investing in capacity in a garmenting unit in Ethiopia. And that is likely to be commissioned by the end of this year. And that is going to drive our export volumes in the garmenting side because there are clearly cost advantages that the unit will have and will expand our footprint in the garmenting business across the Europe and US markets. So that is a positive upside that we see on our export portfolio. Otherwise, the market, remains challenging.
Any target that you have in terms of contribution, from exports that you're likely to achieve in the near term?
No specific number. I think we will have to see as to how the global economic environment pans out. 15-16 was certainly challenging. We saw a dip of 2% in our share of exports to our total turnover. How the interest rates behave, currency devaluations happen will all be factors which will influence our own export volume growth.
Right. And last question, Mr. Bahl, can you tell us, as you mentioned that you will be, putting in a lot of capex for expansion, you've got plans to expand the number of stores that you have? If yes, then by how much?
Yes, we have as of now 1,051 stores, and our focus will be to continue to expand our retail network and also continue to renovate our existing retail network as well. So, 15-16 we added 85 stores, and this momentum is going to continue for 16-17 as well.